Today I want to talk about one of these SPACs, or at least it was a former SPAC. Now it's been out of that SPAC phase for a while now, but it is well under $10, well under everything, and that is Shift Technologies. If we look at a Shift 1 year chart here, we're at 734, which is pretty low. This thing has gone all the way up to $13.98 at one point, back down to $6, and we're now sitting at 734, just 10% over that all-time low in the sixes and very much lower than that all-time high, which of course was just in the SPAC frenzy. This is when it was announced back in June of 2020, so it's almost been a year. And then post-SPAC, this thing dropped all the way down to into the $6 range. But if you guys don't know what the company is, they are a online dealership is in short what they do. They're a newer one. They're only in a few markets and their growth rate is insane. Their profitability is becoming pretty good. That is something that still needs to be sorted out, but they have a really nice interface. They also have the highest customer satisfaction of all of these online retailers who have a pretty low satisfaction rate if you were to just average it out across the entire marketplace. I mean, Vroom is awful, like in terms of customer service. Vroom is not rated very highly compared to Shift. So that's really their main strategic advantage over these other guys like Vroom, Carvana, etc. Very similar business model, but very different ways to get there. But I just want to show you guys the upside real quick. This is just a quick evaluation method, and right now I think that this stock is worth $10.71 by year's end, which is a 45% increase from where we are right now, and that's sitting at only a 2 times price to sales ratio. In comparison, Carvana sits at a 3, Vroom sits at a 2.2, 2.3 at the current moment. So I think anywhere between 2 and 3 is pretty fair, and that's where I got these valuations from. This is a 2-year price to sales. This is a 3 times price to sales. Now I want to show you guys why, okay? So let's look at their earnings and their future guidance, which is very good looking. So first, let's start with Q4. We already know the growth was great. In that quarter, they reached 73.4 million, and in 2020, revenue grew up to 195 million, which is only 18%, but they're expected to grow 130%. Now, I don't doubt it a bit. In 21, there's nothing setting them back like in 2020, which was obvious. They're based out of San Francisco, so the politics alone was really slowing down their business model, considering they deliver the cars to your house, and if you're selling a car to Shift, they will come pick it up from you. So all that human to human interaction definitely was clashing. But they also opened up a facility out in Texas this past year. So just keep these numbers in the back of your mind. Total units sold 13,000. E-commerce units were 9.4 thousand of those, and then wholesale was 3.6 thousand. Another line we need to take note of is this one right here. For the fourth quarter, gross profit per unit was 466 compared to the negative gross profit that it used to be at 505 in the negative. Gross profit per unit is $1,200, so this is something that they need to get up to get it much higher than that. Standard dealerships have it much higher than that, so they need to get a lot of costs down, including the cost to get a car ready from the moment they pick it up to the moment where they detail it, etc., pictures, all that stuff. That is just too much money right now. So if we look at fiscal outlook for the next year, their expected revenue of 450 million, that's 130% increase, and that's exactly what I put on our numbers right here. This is 130%, which would take us to roughly 450 million in net revenue or gross revenue. And at a 2 times price to sales ratio, current market cap is 600 million. I think that would take us closer to the $1 billion market, which is 40 to 60% increase from where we're at right now. And that's a good reason why I've just purchased 400 more shares of this. As I told you guys to mention here, e-commerce unit sales greater than 20,900. If you guys remember before, it was in the 9,000s. This is more than they sold wholesale and e-commerce. This isn't accounting for wholesale either. This is all e-commerce units sold. They expect the GPU to go drastically up over the whole year to $1,600 per unit. Then the margin, they're still looking very negative, but the EBITDA margin is itching towards that positive ROI type. So yeah, that's where we get our numbers here. So I just want to show you this evaluation, how accurate it can be. Now, I'm not looking too far it out, but I believe that this could be very conservative for this company. I think it could reach well higher than that. In comparison here, I'm projecting this thing out to 2026. And as long as they don't go bankrupt or anything, 2.7 billion in revenue seems very likely. roughly, if not more. Carvana, for example, right now is at around 5 billion to 6 billion in annualized revenue. So I see no reason why, as long as Shift is still around and they're providing great customer service, that they can't get to that. The nice thing about buying cars is you're not loyal to one dealership. You're loyal to who has the lowest price for the same exact car. So if Shift and Carvana have the same car and Shift's to 500 less, which one are you going to buy? So that's why I think it's going to be really easy to take a good portion of the market share. They're in early on this online dealership type business model. So I think that they will be able to edge their way into a pretty sizable market share. They're going to be right up there with the Carvanas of the world, with the Vrooms of the world, and have a whole nationwide presence. They already ship nationwide completely as we speak, but by 2026, they should be well more known. And if we're still evaluating these at the same price to sales ratios, the same multiples, in 5 years, if this is at a 2 times price to sales ratio with my very conservative growth rate, I have it slowing down all the way to 20%, 80, 50, 40, 30, 20. This was just an annualized CAGR that analysts have this at. And I just put it over these years. It's the same difference if I were to put it at all 43 or something, 43%. It's the same difference. I just did it how I think it would trickle down. But I think 5 years from now, conservatively, we could be looking at a share price of in the 60 range. Could be under 64, could be over 64, but I think it could be somewhere within this range, which would mean a 777% ROI for us if it were able to do that, and annualize that, and it's 55%. Now, as for my position, I'm not going to act like it's a massive position here, but I actually spent all of my buying power here today just to lower this basis. It was up in I think it was like 830, 840. So I just bought another 100 shares when it dipped here yesterday, I guess it is. And we're down a pretty decent amount right now, but regardless, I think the upside here is so massive that it just does not matter. So I'm currently sitting at 400 shares in the Robinhood account. My Fidelity has more than that, but I like to show the Robinhood one more because I just like the looks of it. It makes it a lot easier to show. Fidelity is not clean, not pretty. But yeah, the Robinhood portfolio, it's a pretty decent percentage of the portfolio, 30%. That's very high, but it just shows how confident I am in Shift Technologies. But hopefully this gives you a little bit of confidence if you are a Shift shareholder. Also, remember to just do your numbers. Maybe you don't agree that they're going to get 130%. I for sure do. We already are getting some Q1 leaks, I guess, or more like estimates for their deliveries, and it's looking pretty good. 140, 150% from Q1 of last year to Q1 of this year. But even if you wanted to adjust this, make your own spreadsheet and say they only grow 100%, you're still looking at a 930 share price, which is obviously 26% higher than it is right now. But play with your numbers. I definitely think that this is very accurate, even if we go and say that this thing grows massively this year and then grows at only 40% a year for the next 4 years after that. I doubt that happens. I think over the next 5 years, our CAGR is going to be around 50 to 60%. And that for me is entirely based off of their current market share plus how fast this industry is growing. But that would put us at $57 share price. But yeah, that's it. Hopefully you enjoyed. Go get out there and buy the dip in any of these SPACs. If any of them toot your horn, you definitely want to get into them right now. They're all in the blender.